allocation. Western region had 30% and Eastern region had 24% in 1946. Okay, and then in 1951, another ad hoc Fiscal Commission and Revenue Allocation Committee was set up, which was known as the Hicks-Phillipson Commission of 1951. All right. Hicks-Phillipson went another route in its own principles of allocation. All right. It came up with 3 also, but in different form. The first principle under the Hicks-Phillipson Commission of 1951 is independent revenue, principle of independent revenue. So the more a region or territory generates a revenue into the general pool, the more allocation it gets. Now, I know you might want to say, is this not derivation? No, it's different. Derivation is talking about, resources or what is coming out in terms of, produce and all that, what the central government is extracting. While independent revenue principle is talking about what that local authority in that local territory has been able to generate in terms of internally generated revenue by whatever scheme it does that, whatever tax scheme or any revenue generation scheme it comes up with. If that territory is generating more, all right, the central pool will allocate more to it. So you have the independent revenue principle. And then secondly, of course, same, we also have derivation principles. I've already explained that. And the last one, which is different from the Phillipson Commission of 1946, is what was known as the need and national interest principle. Okay, so sharing was going to be done on the basis of needs and national interest. So whatever area of the colonial Nigeria that required more intervention, that area will get more allocation given to it. So that was the need and national interest principle of revenue allocation. Okay, so some of the by way of implementation of this Hicks-Phillipson Commission of 1951, we have identified some effects of it. Number one is that regional governments got 50% of import and excise duties on tobacco. Regional governments also got 100% of import on motor spirit. And then capital grants using a 1931 population figures as a determinant factor was also granted to each regions. All right, so they got capital grants, they got 50% of import and excise duties on tobacco, and they also got 100% of imports on motor spirit. Okay, now in 1953, another ad hoc revenue allocation committee was formed, which was known as the Sir Louis Chicks Commission. Yes, so the Sir Louis Chicks Commission of 1943 was also developed, and in this time around, it focused mainly on the principle of derivation. And in that Sir Louis Chicks Commission of 1943, the principle of derivation recommended a formula of 50-50. Okay, so anything derived from a region, 50% was retained by that region and 50% was given to the federal government in terms of extraction, minerals and all that. And apart from that, certain other, apart from extracts, certain other aspects of revenue generation also applied the 50-50 rule. Okay, import and export tax on the basis of consumption was split 50-50. Import duty on motor spirit was split 50-50. Remember, in the Higgs-Phillipson of 1951, import duty on motor spirit 100% went to the regions, but this time around in 1953, under the Sir Louis Cheeks Fiscal Commission, import duties on motor spirit was split 50-50. And then for the northern region, it was 50-50 only in respect of tobacco and motor spirit, while other import duties on other kinds of goods, the north got 30%. And then for the western region, import duty on spirits, which is alcohol, like gin, western region got 40%, while the federal government got 60% of import duty on spirit. For company tax, just as we have today, 100% allocation went to the federal government, while when it comes to mineral royalties, the royalty aspect of mineral extraction, 100% went to the regions. Okay. Ade Ipaye, when he was in his book discussing the Sir Louis Cheek Commission, noted that the commission proposed that each region of the federation should have power to fix the rate of personal income tax. So this 1953 ad hoc revenue committee was the first time personal income tax was mooted to be left to the regions of Nigeria. Okay, so the commission, Sir Louis Cheeks Commission, recommended that each region should fix its own personal income tax, which was already provided for under the direct taxation ordinance in existence, and then that any revenue generated from personal income tax should be shared vertically. Should be shared horizontally between the regions and their respective local governments. Okay, Ipaye observed that the Sir Louis Cheeks Commission also recommended that the federal government fix rates of tax under personal income tax, but as it relates to federal workers. Okay, so that's for Sir Louis Cheeks Commission. And then in 1958, you have the Reisman-Trees Commission, which was another ad hoc revenue allocation committee. It was established, of course, to review the revenue allocation and sharing formula for Nigeria. So for the Reisman-Trees Commission, it introduced something called a distributable pool account. All right, a distributable pool account is more like the federation accounts that we have today. So in fact, we can say that federation accounts as of today got its idea, or got is originated from the Reisman-Trees Commission of 1958, which talks about distributable pool account, wherein all monies generated from all sources are sent to, from which you now have it shared among the regions, the federal government, and so on and so forth. Okay, so it established a distributable pool account, and it's recommended that 30% of revenue generated from mining rents, royalties, and import duties from all items except tobacco, motor spirit, beer, wine, and portable spirits should be sent to that distributable pool account, from which further sharing will be done. And so, on this basis of this distributable pool account, what was happening is that out of funds generated from mining rents, and royalties. Raisman trees recommended